Let's move on and talk about the economic outlook for you. You and I talked not too long ago, a couple of weeks actually, and you had said in our last interview together that you expect gold to hit new all-time highs in a few years, well, 2023 to 2025 to be exact, on the back of new economic problems. I'd like to address this and follow up on what economic problems you're referring to, Jeff.
Yeah, well, our view and the timing is suspect because the economic problems are massive sovereign deficits around the world, not just the United States, but around the world. Governments are borrowing money left and right to support their economies and their people and their corporations. And corporations and people are borrowing money at unprecedented levels. So you have massive deficits between spending and the availability of money. And those deficits are being made up with debt. So you also have a big growth in the debt levels of sovereigns, corporates, and individuals too, to unprecedented levels. Those need to be worked out somehow. There's a strain of belief in the financial markets that it can only be resolved by fire. That's not necessarily true. That's sort of like some strange quasi-religious belief. We could actually resolve the debt problems, but they're going to take many years to do. So debt and deficit spending are the number one economic problems. The second thing is real GDP. Now, we're in a strong recovery right now because we had a really terrible 2020. So You're seeing strong numbers being posted. And you were talking, the IMF has just increased its estimates for real GDP in 2021. They have, yeah. That's a rebound. And, our expectation is 2021, 2022, you're going to see a rebound and recovery. But you have ongoing deficit problems. You have excess manufacturing capacity. Now you have excess retail capacity. You have excess commercial real estate, and you have excess labor in the United States, in Europe, around the world. And so you have a tremendous amount of excess capacity to produce things, but you don't necessarily have the demand to meet that. And most of these industries are changing. Now, these are problems that have been forming for 10, 20 years, and they're getting critical. And we were moving away from computer-assisted design and manufacturing to computerized manufacturing. The pandemic has sped things up. So now you're going to computerized manufacturing, computerized service provision, computerized AI financial management. So all of that surplus manufacturing capacity, retail capacity, labor is going to get much worse very fast. And that's going to put even more weight on sovereign deficit spending and sovereign debt. All of this stuff has to be resolved at some point, and we just don't have the political will to do it, not in the United States and not in most countries. So you've got this glob of economic and financial problems exacerbated by the pandemic, but really going on, and that has to be resolved. Now, if you try to do it econometrically and you say, well, when's the next recession going to be? You cannot project econometrically when a recession is going to hit, how long it's going to be, and how deep it's going to be. Econometrics just don't work that way. People try, we try, but it doesn't work that way. It's great in hindsight. So you have to put a wet finger in the air and say, when do we think the next recession is going to come? How long do we think it's going to be? How deep do we think it's going to be? And given the growth in the economic and financial imbalances, and given the breakdown in international cooperation, and given the desire of central banks around the world to move to a multipolar currency regime system, and given the resistance of the United States and Europe to sharing power within the United Nations, the IMF, the World Bank, with countries that have become more powerful in reality, in the real economy, you have a breakdown in international cooperation just when you need international cooperation to step up and say, hey, we've got to manage our way out of these crises. So we put a wet finger in the air and we say, we think sometime between 2023 and 2025, we're going to have another deep recession.
Let's talk about this other deep recession now. Jeff? Well, we just had a deep recession. People were saying this was the worst on record since the 30s.
Right.
What kind of deep recession are we talking about? Is it something on the same scale, or is it possibly worse?
Well, again, it's hard to say. You can't really econometrically project it. And it's funny because, there are guys in the precious metals market who say, well, the whole thing's going to collapse. And some of those guys have been saying it since they got into the business in the early 90s. Some of them have been saying it since the 70s. We don't believe in collapses. We don't believe that things
When you say whole thing, what are you referring to? What whole thing?
The global financial system.
Oh, right. Yeah. Okay.
I mean, you have these people who have no knowledge of finance and economics talking about the collapse of the dollar, the collapse. I was talking to an investor the other day, and he said, what about the currency reset? It's a term that you hear guys talking about all the time on Kitco, right? There's going to be this great currency reset, and it's like the end of the world. Oh, it's going to be April 1st. No, it's going to be April 20th. No, it's going to be sometime in June. If you talk to central banks, if you go to the central bank, if you go to federalreserve.gov website and you type in currency reset, it's not there. There's a lot of nonsense. But
it's probably just a term to describe the phenomenon. I don't think the central bank is going to advertise it using that term.
It describes an imaginary phenomenon that people have been saying is going to happen for 40 or 50 years, and it has yet to happen.
Well,
and in the interim, we've had some of the strongest growth and some of the longest periods between recessions in history.
That's true.
There's a reality of the economy, and then there's this thing that these guys constantly talk about, the ultimate collapse, and it's going to happen, and it's the end. Well, it's the end of what? I mean, this is life. This isn't a movie. It isn't a novel. This is life. What's at the end of? Is it the financial collapse collapse of the financial system, which basically has actually survived 500 years, including the Napoleonic Wars, World War I, World War II, and the Cold War? What are you looking at? The reality is something other than a collapse. It's a resolution of long-term instabilities that have built up and need to be resolved, but the political will to resolve them hasn't been present.
You mentioned the dollar. Is it not true that the dollar has lost its value over the past couple of decades?
Depends on how you define value. Over the last 100 years, over the last 200 years, the dollar has lost purchasing power. And it does that because you can earn interest on it, which deteriorates the purchasing power. And it does that because of inflation. If you look at the dollar versus certain currencies, the dollar has actually held up very well. And you hear people talking about the dollar collapsing. It's highly unlikely, because for the dollar to collapse or for the dollar to fall sharply, you have to have you'd have to have investors around the world extremely bullish about other economies and other governments and other countries relative to the United States. And the United States still has a tremendous economic advantage over most other countries. And it has tremendous resources compared to other countries, and it has strong productivity. We're throwing it down the toilet quickly, but we still have an advantage, and we could turn that around if we had the political willpower to do that. So if you look at the dollar relative to other currencies, the dollar actually has held up very well, and much better than you would think if you believed the stuff that you read on the internet. So, and for the dollar to collapse, you have to understand 62% of central bank foreign exchange reserves is in the US dollar. About 70 to 80% of private sector financial wealth is in dollar denominated assets. So for the dollar to fall sharply, you would have to have people say, oh, I like Europe. I like Europe's economic prospects more than I like the United States' economic prospects. Because of that 62%, you look at the other 38%, 20% is the euro, 10% is the pound sterling, Swiss franc, and the yen, and the other 10% is everything else. So for the dollar to collapse, you would have to have a tremendous movement out of the dollar into those other currencies because currency rates are reciprocals. So for that to happen, you'd have to have much greater liquidity in those currencies, which would be hyperinflationary in those countries. That's why when you talk to central bankers and you talk about what's a future international currency regime, they say, well, we have different ideas of how it could be and what it could be, but whatever it is going to take decades to move to, because right now the dollar has hegemonic power. Or as a Polish central banker said to me in late 1981, if you owe a bank enough, you own it. And the United States owes the world enough that the dollar has to stay strong because we don't have the dollars. Everybody else does.
Mm-hmm. The status of the reserve currency in history has been closely tied with hegemonic power of the nation state holding that currency. The British pound at one point was the de facto global reserve currency at the height of the British Empire. After the deterioration of the empire, with the rise of the U.S., we saw a shift into the U.S. dollar. So I think people are making the argument, Jeff, that the U.S. will lose its status as the world superpower at some point to another nation, competing nation, perhaps China, and that's when we'll see the dollar decline. Do you see that happening?
Right. Yeah, in the long run, well, yes and no. First off, and again, it's all interconnected. So you have currency market imbalances, you have financial market imbalances, you have economic imbalances, you have military imbalances, and you have political imbalances. And so, you have all these arguments in the United Nations about politics and the IMF about finance and the World Bank about economics, and then among the different governments. Now, if you talk to, for example, people who are in the Chinese central bank, policymakers there, they don't want the yuan to replace the dollar as the de facto currency regime. And they don't want that because they understand history. So they look at France when the franc was the reserve currency and it destroyed the French economy and political base. And they look at Britain and when the pound was the reserve currency and it was disastrous for England. And they look at the United States and they look at the problems that the United States has had economically and politically really since the 50s. We had a number of currency crises in the 50s and 60s when we were on the dollar gold standard. And people don't remember that. They have this nostalgia for a past that was actually not all that great of a time to live. And the Chinese look at that and they say, the last thing we want is the yuan to be the reserve currency of choice. And most central bankers say, ideally what we do is we move to a multipolar international currency regime in which the liquidity of all these other currencies rises to the point where they can be equal to or competitive with the US dollar. Not necessarily replacing the dollar, but coexisting next to it. The problem is the world has never reached such a multipolar currency regime system or regulatory system or political system on a cooperative basis. The currency regime system has always been imposed on the world by the victors of a cataclysmic war.
Well, except the Eurozone, they banded together and formed a common currency.
Yeah, but that's in Europe. And as a former French minister once said to me, it's only 20 years old. That's Europe. That's not the world.
Okay. I'd like to tie this back into gold and we'll wrap it up. You did say that gold would rise to new all-time highs. At around the same time, you projected a new recession. I wonder what the relationship here is. Are you saying that the world is going to need more of a safe haven asset when this recession hits, or you think real interest rates will decline? What's the reason for gold to rise to new all-time highs at this time, Jeff?
It's really, it's a safe haven asset and it's investment demand. In 2000, we issued a buy recommendation on gold and we said, look, we think that the economic and political and financial stability of the world over the next several decades is going to be worse than it was in 1980 when the gold price went from $200 to $850. And therefore, we think the gold price is going to rise, not for 2 years the way it has in the past cycles, but on an ongoing basis because we think there's an upward shift in the investment demand curve. And that has in fact happened. More investors around the world have bought more gold at higher prices for a longer period of time than ever before in history since 2000, 2001. And that's going to continue. And when you have these periodic spasms, as we did 2008, 2009, 2010, 2011, which was actually quite distinct from the Great Recession and global financial crisis, that was the sovereign debt crisis. Then you had 2020, and we're going to have more recessions. You can't predict when a recession is going to hit or how big or how deep it's going to be, but you can predict with 100% certainty that there will be future recessions.
Sure.
Just the nature of economics. When the next recessions hit, what's going to cause it? Probably some problem in the debt market, or maybe another pandemic or something else, but something's going to cause that recession. And when you have that something scaring people and throwing the world into a recession, they will buy gold. If you look at 2020, investors bought something like 44 million ounces of gold, physical gold, real gold, 44 million ounces last year, up from about 17, 18 million ounces in 2018, 2019. Why did they buy more than twice as much gold last year than they did in the previous 2 years? Because they were scared. So when the world scares investors, they buy gold and gold prices rise.
Okay, let me ask you one final question, Jeff. This past year in 2020, had we not had COVID, do you think we would have had a recession anyway? We saw gold rise, but again, that was for a lot of reasons.
Yeah. No, if you go back to the first quarter of 2020, we were predicting somewhat slower growth on a global basis, but we were not predicting a recession. Obviously the pandemic changed everything.
Okay, very good. Jeff, let's follow up on this again, and we'll talk more about the debt crisis and indicators for recessions and other metals next time. Thank you very much.
You're welcome.
And thank you for watching Kitco News. I'm David Lin.